Welcome to the Ask Brad Show. Be prepared to hear ideas, concepts, and strategies that may challenge the way you were taught to think about saving and investing for retirement. It's time to roll up our sleeves and get to it. And now, the host of the Ask Brad Show, here's Brad Williams.
Do you plan to retire anytime in the next 5 years? If so, the clock is officially ticking. But there's a lot more work to be done. And you know what? It's a lot more than you probably know. Planning, preparation you do now, what you do today, could determine your success or failure. Welcome. This is Brad Williams and the Ask Brad Show. And today, we're going to reveal 5 critical steps you must take now before you should ever think of calling it quits from your job. Now, everybody knows saving and investing retirement is how you got to get started. But what you do with the money is what matters. If you retire and you haven't covered all your bases, you're setting yourself up for a big financial fail. Let's talk about what those specific steps are and how you take them in the years leading up to retirement. Coming up on today's show, I'm going to break down a 5-point checklist that you can't afford to ignore, including things like tax-efficient strategies that could help you save thousands of dollars in taxes in your retirement, and why claiming Social Security is more complicated now than ever, and how to avoid leaving tens of thousands of dollars in benefits on the table. And these are benefits that are rightly yours. We're going to talk about successful strategies to invest for income while minimizing risk, and a lot more. So, most of your working life, you're thinking about the steps you need to take to retire. And, thinking about these, they probably weren't a pressing concern. You probably thought from time to time, when you looked at your company handout, what am I going to do with that? When you look back, retirement was like a vague, distant concept rather than something that would actually happen one day. And then suddenly you hit your late 50s, certainly in the early 60s, and you realize without really becoming aware of it, boom, it's here. And then you realize you've been paying attention to those commercials about annuities, reverse mortgages, Medicare, and you're not tossing out those AARP mailing, right into the trash, because retirement looms with a terrifying urgency. In fact, I met with a client today. She's transitioning out of her job, and she's actually on medical leave now, not because she's sick, but because she's burning it up. She's officially in retirement, although she's getting paid full. And she was telling me, because I've been helping her extensively since May get ready for this, she said, Brad, God, this is hard work. I didn't realize all this stuff was so complicated. Well, doing that planning in advance is real important. When you ask yourself, do you have enough savings? Is your money invested too aggressively? Maybe not invested aggressively enough. Will you need long-term care insurance? And I think that's a misnomer, because it's not so much that you need insurance as that you just have a plan, however you're going to pay for it. Do you have a will? What on earth is a reverse mortgage, and why would somebody want one? So you have this abrupt awakening, and it's like a panic attack. It's about 5 years out. But you know what? That can be a good thing. And the reason is these years are critical because the moves you make in that transition period, which is now right before retirement, they're going to substantially improve your life in retirement. And I kind of look at it like I've done a show on the retirement mountain. It's like climbing the retirement mountain. As you're going up, you're in the accumulation stage. As you're going down, you're in the distribution stage. And the fact that there's a preservation stage, and that's at 5 years or so before retirement, where you got to take a full inventory, reassess your strategies, and see what you've got. So in that 5th year, you're looking at that. Okay. Now in the 4th year, you're going to start looking at tax saving strategies and how to manage this early in retirement. And that's where you lay the groundwork, because once you've retired, it's oftentimes too late. So you want to start a tax and income planning process today, because as I mentioned before, it's what you do early that matters later. So then you got 3 years to go and you want to put aside some time to contemplate what retirement will actually mean for you. What are you going to do and how are you going to pay for it? And then as we look 2 years to go, you want to look at the ways to reduce spending and really focus on how you're going to draw your income. So increasing your income, which means you probably ought to be increasing your safety. And then the final year, you review everything. You want to get a second or even a third opinion. You really only have one chance to get this right, and you're now at the threshold. 844-343-6048. That's 844-343-6048. So again, there are 5 critical steps to take before you fully retire. Step 1's about taxes, and they play a critical role and have a profound impact on your retirement. I mean, taxes are the biggest expense for most people in retirement. If you're in fairly good health, you'll probably find taxes are the number one thing and not necessarily healthcare, at least for many years anyway. So if you don't have a tax efficient strategy, you could be paying tens of thousands of dollars or even more. And there's a big difference between tax preparation and tax planning. You know, when you go to your CPA or your accountant, your tax preparer, they're preparing your taxes, making sure everything, you know, all the boxes are checked and that all your 1099s, W-2s, whatever are included. But if you really want to pay fewer taxes in retirement, that's a forward-looking tax planning strategy. It's not about how much money you saved, because contributing money to your retirement account is easy. It's when you withdraw the money, how is it taxed? That's a different ball game. You know, a lot of people think, well, you know, I'm retired. I'll sell some shares of my Amazon or Apple stock or my favorite mutual fund. But if you're doing that for income, you could be really building a bad plan in there, because in a down market, you're going to have to sell more shares to keep that same income. So when the market comes back, you're going to have fewer shares for the future. So you got a double whammy on your losses. You not only lost it today, but you lost it from the future. So, you know, Albert Einstein once said, doing the same thing over and over is a definition of insanity. And we look back in the last 18 years, we've had 50% losses since the beginning of the new millennium. What would a 50% loss do to you today? Today, you got to answer that question for yourself. What would a 50% loss in the market do to your retirement? And then you got to do something about it. And that's getting a second opinion. So you don't want this to happen. I don't want it to happen. Retirement's a huge decision. You got to take the steps to get it right, and you only got one chance. So, you know, when you look at things, you could be paying additional taxes, fees, and penalties. The thought that you were counting on this money to get you through retirement, it could be a fraction of what you thought it would be. Because when you hit 70 and a half and those required minimum distributions begin that are required out of your IRA, 401k, then you got to look at taxes, because if you think you hate paying taxes now, just wait until you have to withdraw from your IRA or 401k. But you can control that. RMDs, required minimum distributions, are widely misunderstood, and really a lot of people ignore them until they happen. So the key is to address that issue early and take care of the tax problems early. So as we sit here, what are the solutions? Well, one, depending on your situation, might be beneficial to have a Roth conversion strategy to systematically start converting some of those accounts to Roths or part of them. It could be that your employer allows a Roth contribution. You may want to start changing your amount that you contribute into a Roth versus a traditional. Now, you don't get the tax deduction, but what happens is you get tax-free income once you start taking distributions. So you're changing tax certainty for tax uncertainty. So when you look at things like Roth IRAs, interest from municipal bonds, withdrawals from life insurance, you know, these are some things to look at for tax efficient strategies, because right now the IRS is licking its chops thinking about your IRA, knowing that all that money's been compounded and you're going to have to start taking out, and that's when they get their payback. So you got to keep that in mind. Keep that in mind. And what I do is I help my clients with forward-looking strategies that help them legally save thousands of dollars in their retirement. And I show people how to prepare a retirement tax savings action plan. When's the best time to withdraw from your IRA, your 401k, other retirement accounts? This Trump tax plan presents an opportunity for a lot of people. So if all this makes sense to you, give us a call, 844-343-6048. And we will give you a free consultation to talk about these 5 steps and give you that second opinion as you're transitioning into retirement. That's 844-343-6048.
At Brad Williams Financial Services, we believe in innovative thinking, and we're not afraid to challenge conventional methods in our approach to managing, investing, and preserving wealth. To learn more about Brad Williams Financial Services or to set up a complimentary review,
call 844-343-6048. That's 844-343-6048. You know, Americans are notorious for overspending when the holiday season rolls around, and while that may be good for the economy, in the short term, it often ends up being bad for household budgets. Overindulging a bit on spending during the holiday season doesn't need to create hardships as long as you know your broader financial situation is in good shape. That's why we've created a holiday gift for you. It's our year-end financial planning checklist, and it's absolutely free. Key items on this financial checklist include taxes, charitable donations, estate planning, health insurance, your risk assessment, goals, and so much more. It's our holiday gift to you, your very own year-end financial planning checklist, and it's absolutely free. So call now, 844-343-6048. That's 844-343-6048.
Now, today, as we come back, we're talking about people who might retire in the next 5 to 10 years. So, as I mentioned before, you're really officially in countdown mode. If you don't have your financial plan all buttoned up, you could be setting yourself up for a big failure. So, the 5 critical steps now that you really need to take care of before you call it quits. Again, you got to have a strategy to maximize Social Security benefits, because that's one of the few guaranteed sources of income that people have right now, and should be the backbone and foundation for a financial plan. You paid the money in, you're just getting your money out, but you want to make sure you get the maximum you can. So many people leave so much on the table because, they claim it too early. They forget about how that affects their spouse's benefits. And, if you want to go to my website, askbradshow.com, I've done some shows on Social Security. I've done some shows on income planning. That's not what today's about, but you can go back and listen to those. In fact, any of my shows are on my site, askbradshow.com. So when we look at all the rules that are involved in Social Security, how and when you claim, these mean money to you. I've often told people there's 2 systems of taxation in the United States today, and I'm quoting from a New York Supreme Court judge from the 1930s. He said, there's one system for the informed and one system for the uninformed. And you're listening to this show probably because you want to be on the informed side. Well, that's my job, is to help you be informed. So looking at tax strategies through making sure you're maximizing Social Security income and minimizing taxes is really, really key. Now, what you might want to do is take IRA withdrawals to allow you to delay Social Security. Because once you hit your full retirement age, when you see that FRA, full retirement age, you start getting an 8% deferred retirement credit. And that will last until you hit 70. Now, there is absolutely no reason to wait till after 70 to take your Social Security, because you're just leaving money on the table. But It could be that taking money out of your IRA or 401k might be a good idea to allow you to defer your Social Security and get the maximum amount out of it. And again, that depends on your situation. Some people may have to take Social Security as quick as they can get it. I hope that's not the case for you, but if you can wait, just remember claiming Social Security is complicated and there's a lot of trapdoors in it. So don't leave money on the table. Your best defense is to make sure you wring every nickel out of the benefits. And with our 5-point Social Security analysis, you can discover the precise time you'll get the most out of your benefits for you and your family. There's a little known trick for boosting spousal benefits, strategies to eliminate or minimize taxes on your benefits, and you might be eligible for additional benefits. We can cover that. So if you're one of the first 5 callers today at 844-343-6048, that's 844-343-6048, I'll tell you how you can get your free Social Security analysis right now. And it's free for listening to the program. No cost, no obligation. 844-343-6048. Now, when I look at past meetings and, about 9 out of 10 of the first time client meetings, and I look at where they're investing the same at 65 as they are at 40. And as our old President Bush used to say, that's just not prudent. I remember Saturday Night Live used to do a good thing on that. Dana, whatever his name was. But you have to change your strategy as you get older. You've got to reduce your risk on your portfolio, or when these big dips happen, and they will, you'll be ready. So if you're thinking about retirement anytime in the next 5 years, like I said, your clock's officially ticking. The 5 critical steps you must take now will help you plan that out. We're going to talk about updating your investments and doing more with the investments while minimizing risk. Everybody wants to talk about asset allocation and diversification. And that is very, very important because a properly diversified portfolio, one that mirrors your appetite for risk, not your advisor, not your uncle, not your brother, but your appetite for risk, can help you through market downturns. But as I look at new clients, oftentimes they're really not prepared for that. They're just crossing their fingers and hoping that they'll make it to retirement without another major downturn. They take on more risk than they know, and they've really got no plans to protect themselves. I call it defensive investing. Show me someone who lost their shirt in any of the previous market corrections, and I'll show you someone who didn't have an updated or diversified plan for managing risk. Because you really can avoid potential market downturns by having the proper risk management strategy. You just call 844-343-6048. I said earlier that Einstein said doing the same thing over and over and expecting different results is insanity. Well, here we are. We're one of the longest run-ups in stock market history. And people are a little cautious right now. But for some reason, many are still thinking, well, it's going to continue to go up. And I see that by the way I look at portfolios when people first come in to see me. So we are really way overdue for a bear market correction. And typical bear market lasts 1.5 years with an average cumulative loss of 41%. And that could be trouble, especially if you're this close to retirement. Because your strength in the past and why you had time to make it up is the very word time. You had time. So when you don't have time, you got to reduce your risk. And I think this past October really reminded us of this fact because there was a lot of white knuckles going on. We saw just about all, if not all, of 2018 solid gains disappear. Now, the last week we've seen, some of those corrections with the Fed signaling maybe that they're near neutral rates, but we'll see. When I ask clients, how'd they do in 2008 and 2009? Did you lose tens of thousands or even hundreds of thousands? And in early 2000s, were you caught up in the tech bubble? That's twice in 9 years that Americans got creamed in their retirement accounts. So if you don't want that to happen to you, why don't we have a conversation? Just give me a call. We can have no obligation conversation, discuss your risk, and discuss what defensive investing really means. Just call 844-343-6048. That's 844-343-6048. You know, when you retire in a bull market, of course, you're in good shape. But what if you're retiring in a bear market? Why take the chance that you're going to be in either? Why not have an exit strategy in advance? And when we look at things like required minimum distributions, which start at 70.5, bear markets can kill you in those, because if you're having to take a certain amount of money out and the value of your shares has dropped, you're going to have to cash out more shares to get that same amount. So having the right strategy for getting income from your retirement accounts, such as dividends, interest, things like that, makes more sense than cashing out shares. For example, do you know the investments you own? Do you really know them? Do you know your asset allocation? Do you have any clue of what your downside risk is? Because you need to know the answers to these questions. The sooner you do, the better off you'll be. You know, you've worked hard, you made sacrifices, but now what? It's what you do with your money that really matters. What's your plan for Social Security, for Medicare, for taxes, for health care, long-term care, required minimum distributions? There are many things. And my 5-step retirement action plan focuses on these 5 key things. Single most important strategy is ensure you wring every nickel out of your Social Security. And the latest wrinkle in Medicare and how you can avoid getting gouged in premiums. And a lot of other strategies that successful people are using to ensure their money lasts as long as they do. So if that's what you want for you, be one of the first 5 callers, 844-343-6048. That's 844-343-6048. And we can talk about this 5-step retirement action plan and whether it might benefit you. No cost, no obligation.
At Brad Williams Financial Services, we understand the struggles that families and business owners face today. We want to help you develop, implement, and monitor a strategy that's designed to address your personal objectives and individual situation. To learn more about Brad Williams Financial Services or to set up a complimentary review,
call 844-343-6048. That's 844-343-6048.
This is Brad Williams, and I have been privileged to have been an instructor over the last 12 years or so at the Osher Lifelong Learning Institute at the University of Alabama in Huntsville. They have some great course offerings. I'm currently teaching a course that I've written and taught for many years, Changing Face of Retirement in the 21st Century. But that's not all of the courses there. You can learn languages. You can learn hobbies, travel. There are so many things that you can get out of these courses they offer at the Osher Lifelong Learning Institute. So check it out today and come keep your brain working.
For more information on the Osher Lifelong Learning Institute, call 256-824-6183. That's 256-824-6183. Or email olli.info@uah.edu. The Osher Lifelong Learning Institute. Come keep your brain working. Have you missed any of today's show? Would you like to listen to past shows? We've got you covered 24/7. Visit AskBradShow.com. That's AskBradShow.com.
So as we're back again, we're covering the 5 critical steps you must take now before you can ever think about calling it quits and retire. We went over healthcare costs, long-term care, required minimum distributions, strategies for investing. But when we look at, as I mentioned, taxes will probably affect the most people as far as being the biggest expense. We have to look at healthcare expenses. You've got Medicare premiums. You've got whether you have a supplement or not. Those of you who are in the military, looking at TRICARE for life. What are your deductibles? What are the copays? How long do you think you're going to live? I mean, everybody wants to live longer. Of course, we want a quality life, but we got to remember we're going to be paying for healthcare. Because if you look at your retirement in 3 phases, kind of the go-go years, the slow-go years, and the no-go years, we have to plan for these things. There's a lot of talk about long-term care. I did a show on long-term care. I'm not going to spend a lot of time with that now, but that's something that needs to be looked at. And what I mean is not necessarily long-term care insurance, but having a plan. There are several ways to take care of that issue that don't require insurance. Have you looked at those? Because that's something we may want to talk about. There's been a lot of changes in that long-term care insurance arena, premium hikes that have been significant, underwriting's tightened up so much that only the cream of the crop's going to get approved these days. So looking at long-term care with someone who understands it like myself is going to be really important because health care is going to be a large cost of retirement. You got to think about that. That's where taxes come in because taxes can impact your Medicare premiums. All these are important. So really, as we wrap up, successful retirements are not built on assets, the money you save. It's built on your ability to generate income. So you got to have diversified sources of income. And getting income today is tougher because interest rates are low, although they are going up. And you've got to have the right strategies. So if you're having a fear of running out of money, I'll show you someone who doesn't have a plan for generating income. It's got to be diversified, and you got to take into account many different factors. So call in, get our 5-step retirement action plan. And that's when we talk about the 5 biggest issues that could help make your money go further in retirement. We can schedule a time to meet, review. I can share my thoughts with you. No cost, no obligation, no sales pitch, no pressure, no products to buy. Just conversation and getting a second opinion. So if you want to schedule this, just give us a call, 844-343-6048, and tell them I want to talk about my 5-step retirement action plan and see how it impacts me. 844-343-6048.
At Brad Williams Financial Services, our goal is to develop enduring, long-term personal relationships with our clients, knowing that you have placed your trust in our expertise and dedication. To learn more about Brad Williams Financial Services or to set up a complimentary review,
call 844-343-6048. That's 844-343-6048. Thanks for listening to our show today. In retirement, you only get one chance to get it right, and we know that proper information leads to informed decisions. And that's why we hold free informational workshops in our area every month. Topics like Social Security, RMDs, the latest retirement tax strategies, IRAs, estate planning, and so much more. For dates and times of the next free workshop in your area, just pick up the phone. Give us a call today. Call 844-343-6048. That's 844-343-6048. Taxes, taxes, taxes. It's not about how much you make. It's about how much you keep, especially in retirement, especially with a new tax law. Going forward, what will this mean for you and your taxes? Brad Williams has created a tax cheat sheet. It's a 2-page reference guide on the new tax bill and how it may affect you. For your free tax cheat sheet, give Brad a call at 844-343-6048. That's 844-343-6048. Or visit AskBradShow.com. That's AskBradShow.com.
Imagine this. You're over 50 years old. You've been married for 25 years. And now your spouse just drops a big bombshell on you. They want a divorce. Welcome to the new phenomenon, gray divorce. The key is, what does all this mean for your finances? Well, welcome to another edition of the Ask Brad Show. Hope you had a great week. And today we're going to talk about a topic that, it's not the best topic to talk about, but it's one that affects more and more people. And that is gray divorce. It seems like every time we get a new phenomenon, somebody comes up with a name for it. Even though most people aren't gray after 50 anymore. I guess it's a miracle of modern chemistry. But let's talk about what that means. And family breakups are never good. And especially even at 50, sometimes you still have children in the home in one way or another. And that's always tough from a family standpoint. But what we're going to talk about today is, what does it mean for retirement readiness? What does it mean for your finances? Because these are questions that people need to know the answer to. Who knows? If they knew the answer to these questions, they might try to work it out and not get a divorce. But we're going to take a look at them. And we're going to break it down into categories. The first would be retirement readiness. What does a divorce after 50 mean to things like your pension, your 401k, things like that? We're going to discuss the ins and outs of that and things like home ownership, because you've both been living in the same home. There's often a struggle who gets to keep the home. Does it make sense to keep the home? And we're going to discuss some of the details of that. With the new tax bill, alimony has become a whole different situation. So we'll look into that. And then Social Security, because Social Security, that brings in some new twists to an already complex situation. So we're going to get started right away, and we're going to take a look at one of the most asked about for those that I've met with who come in who are going through that phase. And that is, what is this going to mean to my retirement accounts? Well, I think undoubtedly the most important thing is, it's going to put you at risk to not be able to meet your retirement goals in many cases. When you look at, you've planned on two incomes, maybe you've got two 401ks, two pensions, that Social Security combination, all those things where you've sat down and you've figured out where you're going to be at retirement, that's all changed now. In fact, interesting statistic is that divorce has a greater impact on couples who have remarried than individuals who remain single after a divorce. That's kind of an interesting statistic. And it's also estimated over half of American households approaching retirement have experienced divorce. So we need to take a look at that. So as I mentioned, pensions. And when we drill down into pensions, there's a lot of things you really need to know up front about how your pension is going to be handled. For example, maybe questions you should be asking yourself. Does your spouse have more than one pension? Does he have one with the current job, or she, or with a previous job? Next, have they worked long enough to earn a pension? Big question is, what's the accrued benefit? What's the accrued value of that? Because oftentimes that qualified domestic relations order is going to need to know that. What is the value of the pension, and what is that fair share? So having that pension valued is going to be very, very important. So you've got one big thing that falls into that, which is the qualified domestic relations order. And that's what's necessary to get pensions distributed. So what typically happens, as soon as the divorce proceedings start, your attorney contacts your spouse's plan and gets their quadro procedures. Every company's a little different. And some of them even have their own forms because they've done that so many times. And does the order, the quadro order is what I'm speaking of, clearly specify what amount is to be paid to you? And that's very important that your lawyer get that. And when is that payment eligible? Does the order provide for survivor benefits so that you can continue to get benefits if your ex-spouse should die first? In most cases, company pensions provide a survivor benefit 50% of the spouse's benefit, and even ex-spouses can receive them, but they must be specifically included in the quadro to get that. So remember that. When you're dealing with pensions, there are certain things that need to happen to make sure that that's done properly.
At Brad Williams Financial Services, we believe in innovative thinking, and we're not afraid to challenge conventional methods in our approach to managing, investing, and preserving wealth. To learn more about Brad Williams Financial Services or to set up a complimentary review,
call 844-343-6048. That's 844-343-6048. If you're preparing to retire in the next 10 years, this message is for you. One of the biggest sources of income may be how to claim your Social Security. That's right, how you claim your benefits. Do you know your full retirement age? Do you know how much your benefits may be taxed? Do you understand how to claim on an ex-spouse? Or even that you could? For your free commissioned report on Social Security maximization, call 844-343-6048 or visit us online at AskBradShow.com. You could spend hours and hours searching around online only to find some generic calculators that may not factor in inflation, tax implications, your marital status, and hundreds of other variables. For your free commissioned report on Social Security maximization, call 844-343-6048 or visit us online at AskBradShow.com. A message from Brad Williams Financial Services, LLC, right here in Huntsville.
Do you have a plan or just a portfolio? Is your asset allocation structured for when you start your required minimum distributions? Are you investing for income or investing for growth for your retirement years? Have you reviewed your income options from distributions to make sure they're the most tax efficient as possible? Have you taken a look at the optimal time to take Social Security, and do you have a written plan of why that's a good day? If you've not had these discussions with your financial advisor, maybe you just have a portfolio and not a plan. Call for a free consultation at 1-844-343-6048. That's 844-343-6048.
A message from Brad Williams Financial Services, LLC, right here in Huntsville.
Investment advisory services offered through Sound Income Strategies, LLC, an SEC-registered investment advisory firm. Brad Williams Financial Services and Sound Income Strategies, LLC, are not associated entities.
Getting back to pensions and 401ks, and, frankly, with today's financial environment, pensions are becoming less and less common. 401ks are becoming the standard. So the key thing in there is making sure you divide it properly through a quadro. And remember, you just can't say, well, I really don't want to take it out of my 401k because it's doing well, so let me just write a check. Well, that's problematic in itself as well. So figure out how best to separate that out. If you're going to get a divorce, try, if you can, to sit down, have a meeting, and just list everything that needs to be divided and try to come up with some plan and some process yourself. And understand this may take several meetings if you're going that route, because when you get two attorneys involved, no offense to you attorneys out there, but then that adversarial relationship becomes even greater. I had a real good friend. They were both chiropractors. They had a very successful chiropractic practice. And unfortunately, they decided to get a divorce. They were from a small town down in Florida. They ended up fighting. And it seems like every time they came to an agreement, one of the other attorneys figured out that there was something wrong with it. It was almost like they called each other prior to the meeting and say, okay, who's going to object today? That's just joke fun, but think about that. And they ended up spending about $50,000 in attorney's fees to get a divorce. And it really hurt their practice because nobody knew whose it was, so they quit caring about it. And I'm sure their patients understood that. It ended up being a 2-year process that neither one of them have really recovered from emotionally or financially. So even though you may not be disagreeing on the big issues, try to work them out because it's going to pay off financially in the long run. So when you look at a gray divorce, what you're doing, you're splitting everything up. You may not have time to catch up financially to make your retirement what it should have been. So just keep that in mind as you're going through the process. Remember, your 401k, your IRAs, your Roths, and remember this too. A Roth IRA has already had the taxes paid. So, what you don't want to do is say, okay, I'll take the traditional IRA and you can have the Roth. I mean, you may want to do that, but you've also got to remember when you hand that Roth to that divorced spouse, you're giving them tax-free money. So you need to make sure all that comes into that calculation. And it's really a fine line that you've got to walk to make sure that everything goes the way you want it to, because, things happen. So just remember that when you're dealing with pensions, when you're dealing with IRAs, take your time, get some financial help. Good financial advisor might be able to give you some key tips on how to negotiate to make sure, you're not cheating yourself and you're not being cheated. So just remember that when you're dealing with retirement accounts, you're dealing with a lot of tax implications and they've got to be done right or else you end up with all kinds of issues. Now, next, I want to talk about home ownership. We'll briefly touch on this before we go to break. But, there may be a situation where one spouse really has an emotional attachment to the home, maybe because of children or whatever. And so then the negotiation comes how to split that up. You quit claim deed and all that. Remember a couple of key things that you need to understand going in. Now, you may understand these things and go along with them, and that's fine as long as you understand them. But things like the mortgage, maybe it's not an opportune time in a mortgage to refinance. Well, remember, if you've done a quit claim deed to give that house to that spouse and you're still on the mortgage, you're still liable for those mortgage payments. So remember that. Just like credit cards, you need to make sure that you've handled those credit cards properly, either froze them or closed them. And remember, when you close accounts, you're cutting off, especially accounts that have been there for a long time, you're cutting off credit points that are in your benefit. The longer you've held a revolving credit account and paid it in good stead, the more it helps your credit. So don't just go haphazardly closing everything. But getting back to the home, making sure that, you may decide, well, in lieu of my ownership percentage in the home, I'll take some of your 401k. And just remember that when you do that, you're taking before tax money. So build that into your calculation. So there are so many things along those realms to take into account. Now, there may be some children left in the house and leaving the children in the home to where they're less impacted by the divorce may be important to you. But just remember, when you're including that home in the calculation for a divorce, you take into account the mortgage, you take into account the value of the home. You take into account as the spouse who may be keeping the home, you're getting ready to accept a liability and an expense that was shared previously. So if you can afford it, great, but make sure you can. It could be that selling the home and downsizing at this point in time may make sense. And in lieu of the real estate market now, it might, depending on your situation, because home values have gone up. Just remember to keep all that into the calculations.
At Brad Williams Financial Services, we understand the struggles that families and business owners face today. We want to help you develop, implement, and monitor a strategy that's designed to address your personal objectives and individual situation. To learn more about Brad Williams Financial Services or to set up a complimentary review,
call 844-343-6048. That's 844-343-6048. Thanks for listening to our show today. In retirement, you only get one chance to get it right, and we know that proper information leads to informed decisions. And that's why we hold free informational workshops in our area every month. Topics like Social Security, RMDs, the latest retirement tax strategies, IRAs, estate planning, and so much more. For dates and times of the next free workshop in your area, just pick up the phone. Give us a call today. Call 844-343-6048. That's 844-343-6048.
Welcome back. We had been talking about the gray divorce, and we had discussed retirement accounts and the implications of splitting up retirement accounts, the implications of pensions, and how to take into account during your negotiation, during the process of how those should be split up. In the 401k, the Roths, how you need to make sure that you're taking into account the tax implications of each one as you're splitting those up. And next, I want to go into alimony because, alimony has been around for a long time. It was often used in a negotiation. It could be that in lieu of property, I would give my ex-spouse alimony. And now the tax implications of that have changed with the new tax bill. So you need to keep that in mind because it's not the clean thing it used to be. If you're going through a divorce and it's finalized by the end of 2018, the person paying alimony is going to be able to deduct that expense from their gross income. So if you've got a higher income individual, then it may make sense for them to pay alimony, and a lower income individual, of course, as they report it as income, they're going to be in a lower tax bracket, so it may not have the impact otherwise from a tax standpoint. So now after 2018, so as we go into 2019, people who are getting divorced in 2019 and who are paying alimony are no longer going to be able to claim that as a tax deduction. And what I mean is the payments they're making as alimony will no longer be deductible. In exchange now, the person receiving it's not going to have to report it as income. So as a result of this, a higher earning spouse, they may no longer be able to afford to pay as much alimony as they had in the past because they've lost that tax deduction. And that could leave the other spouse, typically a woman, in a less secure financial position. So, and then another key thing in the tax bill is these laws expire at the end of 2025. So, got to calculate all that in there. So remember, as far as alimony is concerned, that's a whole new animal now if you're not going to be finalized by the end of the year, which would be kind of tough in most divorce proceedings. So the rules of alimony have changed going forward. Now let's talk about Social Security. If you're divorced, but your marriage lasted 10 years or longer, you may not realize this, but you can receive benefits based on your ex-spouse's record. So there's a few key components of that you got to qualify for. First off, you got to be currently unmarried. If you've gotten remarried, bets are off. You got to be 62 or older. Your ex-spouse has got to be entitled to Social Security retirement or disability. And the benefit you're entitled to receive based on your own work is less than the benefit your ex-spouse receives. So your benefit as a divorced spouse is equal to 1/2 of your ex-spouse's full retirement amount, and that's at full retirement age. Obviously, you got to hit full retirement age to get that maximum benefit. And the delayed retirement credits don't affect the ex-spouse's benefit. And what I mean by that, if you're taking benefits based on your husband's Social Security and they're gathering deferred retirement credits, you don't get benefit of that any more than you would if you were married. Once you hit that full retirement age, that's the max benefit. So if you remarry, you're not going to be able to collect on your former spouse's record unless your later marriage ends by death, divorce, or annulment. So in that respect, you can't be married. You could have been remarried, but you can't be currently married. If your ex-spouse has not applied for retirement benefits but can qualify for them, you can receive benefits on their record if you've been divorced for at least 2 years. So that's a good thing. Now, if you're eligible for retirement benefits on your own record and your divorced spouse's benefits, they're going to pay the retirement benefit first. If the benefit on your ex-spouse's record is higher, you're going to get an additional amount on your ex-spouse's record. And so that way the combination equals a higher amount. So just remember that Social Security, you can collect on an ex-spouse's benefits. It does not affect their benefit. They may not even know you're doing it because it really doesn't affect them. It's a calculation based on you and based on their work record and their earnings. So remember that as you look at those things you need to take into account as you're planning for retirement and you're divorced. Now, as I mentioned, the tax laws have changed with the new tax bill, and that really affects everybody in one way or another, not just divorced spouses. And there's a lot of key things in there. Brackets came down, or I should say tax rates in those brackets came down. The standard deduction was increased, the personal exemption phased out. So these are some key things you need to know as you're looking at retirement, is what your tax situation is going to be. And I've offered this before, but I provide my clients what I call my key financial data sheet for 2018. And it has tax rate schedule. It's got standard deduction exemptions, tax rates on long-term capital gains, retirement contribution limits, Medicare premium brackets, the difference in Social Security, required minimum deductions, all this on a handy to use, 1-page, 2-sided, what I call my tax cheat sheet. And I would be overjoyed to be able to provide that to you. If you can call 844-343-6048. That's 844-343-6048. And just ask for the tax cheat sheet. Give us your email or your address. We can send it to you in digital copy or hard copy. No cost, no obligation, just as a benefit of being a listener to the Ask Brad Show. And I think you'll find it very beneficial. I've been using these for many years, and my clients look forward to getting them every year because it helps simplify their process and their planning for the year. So a real handy sheet. Again, just give us a call, 844-343-6048. That's 844-343-6048. Or you can send me an email at brad@askbradwilliams.com. That's brad@askbradwilliams.com. I'll send you a digital copy if that's what you'd like. Again, no cost, no obligation. So as we're wrapping up here, just as a quick overview, gray retirement's affecting more and more people, and having the right planning process. If you're going through that, it's already a tough process on its own, but make sure you're planning for your retirement readiness, that you've looked at the implications of pensions, of 401ks, of Roth IRAs, of 403Bs, of all these things, and that they come into the planning process so they can be split up properly. Home ownership, who gets to keep it? If you've got equity built into it, how you're going to distribute that equity. Looking at alimony, you're going to pay alimony, you're not going to pay alimony. Remember, if it's done by the end of 18, it's got one set of rules. If it's done after January 1st, 2019, and when I say done, I mean finalized, then it has a different set of tax rules. Looking at Social Security and understanding that you do have some benefits there, and that you can draw benefits from a former spouse if they were the higher income earner and they're going to have greater benefit than you. These are some of the things that really need to come into play. And, if you're going through this and don't have a financial advisor, would find it beneficial to sit down with one who has helped clients through this before, give us a call. I'd be happy to give you a free consultation, 844-343-6048. That's 844-343-6048. And if you know someone that's going through this, refer them to our radio show website, theaskbradshow.com. Typically by Monday or Tuesday after the show is posted, it's up on the website. You might just send a link to them, have them go to the website and listen to it. Hopefully they'll find some benefit in it as they're going through this really tough process, and, maybe that'll help out. So, well, have a great day. I want to thank you for listening today, and we'll talk to you next week.
That's all the time we have for today. To learn more about Brad Williams Financial Services or to set up a complimentary review,
call 844-343-6048. That's 844-343-6048.
Investment advisory services offered through Sound Income Strategies, LLC, an SEC-registered investment advisory firm. Brad Williams Financial Services and Sound Income Strategies, LLC are not associated entities.